The crypto market is a roller coaster. One day you're up 100%, the next day your portfolio crashes 50% overnight. It's brutal, it's stressful, and if you're not careful, it can drain your energy, your focus, and even your bank account. But what if I told you that market volatility is actually your biggest advantage, if you know how to handle it? In this episode, we're diving deep into the mindset, strategies, and psychology you need to stay calm, make smart decisions, and thrive in a volatile crypto market. No panic selling, no emotional breakdowns, just pure strategy, mental clarity, and profitable moves. Let's get into it. Before we master how to stay calm, let's break down what market volatility actually means. Crypto is known for its wild price swings, and unless you understand why it happens, you'll always feel like you're caught in a storm without an umbrella. At its core, market volatility refers to how much and how quickly an asset's price fluctuates. In the crypto market, these fluctuations are often extreme, making it one of the most volatile asset classes in the world. While stocks might move 1-2% a day, crypto can easily swing 10 to 20% or more in hours. But what causes this volatility? Let's explore the key factors. Liquidity refers to how easily an asset can be bought or sold without drastically affecting its price. Traditional stock markets have massive liquidity because of institutional investors, market makers, and regulations that stabilize price movements. Crypto, on the other hand, has far less liquidity. This means that a few large trades can significantly impact prices. Imagine someone selling $100 million worth of Bitcoin. In traditional finance, this would barely move the price. But in crypto, where liquidity is lower, it could trigger a massive drop, leading to panic selling. Low liquidity also makes price recovery slower after a major sell-off. If there aren't enough buyers in the market, prices can stay suppressed for a long time, creating extended downtrends that shake out weak hands. Unlike traditional markets, where institutions control most of the trading volume, crypto is heavily driven by retail investors. The problem? Retail investors are highly emotional. Most newcomers enter the crypto market without a solid strategy, relying on hype, social media influencers, and FOMO, fear of missing out. As a result, they make impulsive decisions based on short-term price movements rather than long-term fundamentals. This emotional trading leads to huge price swings, as thousands or even millions of investors jump into a coin when it's trending, only to dump it when fear kicks in. The result? A market that moves up and down unpredictably, driven by emotions rather than logic. Leverage trading allows traders to borrow money to increase their position size. While this can amplify profits, it also greatly increases risk. For example, if a trader uses 10x leverage, a 10% move against them can wipe out their entire position. When many traders get liquidated at the same time, it creates a domino effect, where liquidations trigger more liquidations, leading to massive price drops in minutes. This is why crypto often experiences sudden flash crashes, where prices plummet out of nowhere. Liquidations are hitting the market all at once, forcing prices lower. Large players known as whales have the power to move the market in their favor. Since crypto markets are still relatively small compared to traditional finance, a single entity holding millions of dollars worth of Bitcoin or Ethereum can orchestrate massive price swings. Here's how they do it. A whale dumps a large amount of crypto, causing the price to crash. Retail traders panic and start selling. Once the price drops low enough, the whale buys back at a cheaper price, making a profit. This cycle repeats over and over, leaving emotional traders at a disadvantage. The key? Recognizing manipulation and not reacting emotionally to it. One tweet, news article, or government announcement can send the crypto market into chaos. Examples of FUD, fear, uncertainty, and doubt that have caused market crashes include a government announcing potential crypto bans or regulations, a major exchange getting hacked, a big institution selling off their crypto holdings, and fake news about Bitcoin's death or irrelevance. Crypto investors react strongly to news, often without verifying facts. This creates panic-driven sell-offs, where the market crashes before the truth even comes out. The takeaway? News impacts the market, but the real pros know how to filter out the noise. The biggest reason people lose money in crypto isn't the market, it's their own emotions. While volatility is part of the game, most traders fail to manage their emotions, leading to impulsive decisions, bad trades, and unnecessary losses. Crypto markets tend to move in predictable emotional cycles. The problem is, most traders fall into these traps again and again. During bull markets, they think, "This is going to the moon, let me buy more," or "I don't want to miss out, let me FOMO in," or "Crypto is the future, prices will never drop." During crashes, they panic and think, "Oh no, I'm losing money, I need to sell before it goes to zero," or "I should have never invested, this is a scam," or "Crypto is dead, I'm out." This cycle of FOMO and panic selling is what keeps most traders stuck in endless losses. They buy high out of greed and sell low out of fear, the exact opposite of what successful investors do. Let's break down exactly how emotions ruin trading decisions. When the market drops suddenly, inexperienced traders panic and sell at a loss. Instead of waiting for a rebound, they exit the market in fear. The result? They lose money unnecessarily. When a coin starts pumping hard, emotions take over. People rush to buy, thinking, "I don't want to miss out." The moment they buy, the price crashes, leaving them stuck in losses. Emotional traders chase every price move, thinking they can predict the next big rally. This leads to constant buying and selling, racking up fees and bad trades. Instead of making profits, they bleed their portfolio dry. Emotions make traders ignore stop losses, over-leverage, and take unnecessary risks. Instead of playing it safe, they bet too much on a single trade, leading to massive losses. The solution? Removing emotions from your decision-making process. If you want to succeed in crypto, you must master emotional control. The best investors and traders have one thing in common. They stick to their strategy no matter what happens. Here's how to develop the right mindset. Accept that volatility is normal. The moment you accept that crypto will always be volatile, it becomes easier to stay calm. Instead of fearing price drops, expect them and use them as opportunities. Detach emotionally from price movements. Stop checking your portfolio every 5 minutes. It only makes emotions worse. Set pre-planned buy and sell targets and stick to them no matter what. Have a long-term perspective. If you believe in the fundamentals of crypto, short-term swings don't matter. Instead of reacting emotionally, focus on where the market will be in years, not weeks. Use risk management. Never invest more than you can afford to lose. Set stop losses, take profits, and avoid using high leverage. Control your reaction to news and FUD. Before reacting to news, verify facts and think logically. Don't let the media dictate your investment decisions. The bottom line: crypto rewards those who can stay calm, think rationally, and execute a smart strategy. Master your emotions, and you'll start seeing real success. Cryptocurrency is one of the most volatile asset classes in existence. Prices can swing wildly within hours, driven by a combination of market sentiment, leverage, liquidity, and institutional movements. For new investors, this can be overwhelming. However, understanding volatility and learning how to navigate it is the key to long-term success. Before diving into strategies for handling market swings, let's break down why crypto is so volatile and how emotions play a critical role in trading success. Before mastering how to stay calm, it's essential to understand what market volatility means and what causes it. Unlike traditional markets, crypto is a highly speculative and unregulated space where large price movements are common. Here are the primary factors behind these fluctuations. Traditional stock markets have institutional investors, regulations, and deep liquidity, which stabilizes price movement. Crypto markets, on the other hand, are relatively thin, meaning even a few large trades can cause dramatic price shifts. In less liquid markets, sudden buy or sell pressure leads to extreme volatility. A large portion of the crypto market consists of retail investors, many of whom trade based on emotions, social media trends, and FOMO. Unlike stock markets, where institutional investors provide stability, crypto is heavily influenced by retail sentiment, leading to wild price swings. Many traders in crypto use margin trading with high leverage. When prices move against them, their positions are liquidated, causing a cascade of forced sell-offs, driving prices down further. Similarly, during uptrends, liquidations on short positions cause rapid price surges. Whales and institutional investors often manipulate price movements by executing large trades that trigger stop losses or liquidate leveraged traders. They intentionally create fake breakouts and breakdowns to shake out retail investors and buy at lower prices. Crypto is highly news-driven. A single regulation announcement, a tweet from a billionaire, or a major exchange hack can cause panic. FUD spreads quickly, leading to panic selling. Conversely, hype cycles cause unsustainable FOMO rallies, leading to sudden crashes when the excitement fades. Key takeaway: volatility is normal in crypto. Instead of fearing it, you must learn to manage it. The sooner you accept this, the easier it becomes to develop a mindset that keeps you calm and focused. Most traders don't lose money because of the market. They lose because of their emotions. When prices go up, emotions take over. During bull markets, they think, this is going to the moon, let me buy more, or I don't want to miss out, let me FOMO in. Then the inevitable crash comes and fear sets in. This cycle of FOMO and panic selling is the number one reason traders fail. The ones who win are those who control their emotions and stick to a disciplined strategy. So, how do you develop this mental discipline? Mastering your emotions isn't about ignoring them. It's about controlling your reactions. Here's how to develop a strong, disciplined mindset. Zoom out and see the bigger picture. Crypto is a long-term game. Bitcoin has crashed over 80% multiple times but keeps recovering. If you panic over daily or hourly price movements, you'll make impulsive mistakes. Look at multi-year trends instead of focusing on short-term fluctuations. Detach from your portfolio's value. Checking your portfolio 10 times a day will only increase stress. Set a fixed schedule to check prices, once a day or even once a week. The less you obsess over prices, the less emotional you become. Have a pre-planned strategy. Decide your entry, exit, and stop-loss levels before you invest. Never make impulsive decisions based on emotions. Write down your investment thesis and stick to it, no matter what the market does. Expect volatility and accept it. If you're investing in crypto, you signed up for volatility. Mentally prepare for a 30-50% drop before it even happens. When it does, remind yourself, this is part of the game. Practice mindfulness and detach emotionally. Meditate, exercise, go for a walk. Find ways to detach from market movements. Remember, you can't control the market. You can only control your reaction. Having the right mindset is crucial, but you also need a technical approach to managing risk. Never invest more than you can afford to lose. The easiest way to stay calm? Don't invest money you need. If losing that money would ruin your life, you're overexposed. Use a stop loss and take profit strategy. Set stop loss orders to automatically sell if the price drops too much. Set take profit levels to lock in profits instead of getting greedy. This removes emotion from decision making. DCA or dollar cost averaging instead of lump sum buying. Instead of going all in, spread your buys over weeks or months. This reduces risk and smooths out your average entry price. Use multiple time frames to analyze trends. Don't base trades on 5-minute or 1-hour charts alone. Check daily, weekly, and monthly charts to understand the bigger trend. Avoid high leverage trading. Leverage can amplify gains, but it also wipes out accounts fast. Many traders lose everything due to liquidations. If you must use leverage, keep it low, 2x to 5x max, and manage risk carefully. Hedge your portfolio during high uncertainty. Convert part of your holdings into stablecoins during extreme volatility. Diversify into multiple assets instead of putting everything into one. The cryptocurrency market is one of the most emotionally charged financial spaces in the world. Prices swing wildly, news headlines cause panic, and social media is flooded with both fear and euphoria. If you let these emotional waves dictate your trading decisions, you're almost guaranteed to lose money. Successful crypto investors understand the power of ignoring FUD and hype. Instead of reacting emotionally, they focus on fundamentals, long-term trends, and solid strategies. In this guide, we'll break down how FUD and hype control market sentiment, why they lead to costly mistakes, and how to build a mindset that filters out the noise. FUD stands for fear, uncertainty, and doubt, a tactic used in financial markets to spread fear and manipulate prices. It happens in every industry, but crypto is especially vulnerable because it's a new, speculative, and highly unregulated space. Why is FUD so common in crypto? Media sensationalism. News outlets thrive on extreme headlines because fear sells. Market manipulation. Whales and institutions spread FUD to crash prices, then buy the dip. Lack of regulation. The absence of strict rules allows misinformation to spread unchecked. Emotional retail investors. Many crypto traders react emotionally rather than logically, amplifying panic. Common FUD narratives and why you should ignore them. Bitcoin is dead. This happens every market cycle. Bitcoin has died over 400 times according to media reports. After every major crash, Bitcoin eventually recovers and reaches new highs. Weak hands panic sell, while smart investors buy when others are fearful. This regulation will kill crypto. Crypto has faced constant regulatory threats since its inception. China banned Bitcoin mining, the US has imposed strict policies, and multiple governments have introduced restrictions. But crypto still thrives. Regulations often bring legitimacy to the industry rather than destroy it. A major exchange just collapsed. Crypto is over. Mt. Gox collapsed in 2014, causing panic, yet Bitcoin survived. FTX collapsed in 2022, causing a market crash, yet the market recovered. Bad actors may fail, but the technology behind crypto remains strong. Crypto is a bubble and will go to zero. Critics have called Bitcoin a bubble since 2011. Every asset class goes through booms and busts: dot-com stocks, real estate, gold, and even AI stocks. Bitcoin and Ethereum have stood the test of time, proving they aren't just another fad. Key takeaway: FUD is meant to scare you into making emotional decisions. If you believe in the long-term future of crypto, these narratives shouldn't shake your confidence. Hype is the opposite of FUD. Instead of fear, it creates irrational excitement. It's often used to pump the price of low-quality coins so that early investors can dump them on unsuspecting retail traders. Why is hype so dangerous? It creates unrealistic expectations. This coin will 1000x in a month. Almost never happens. It leads to FOMO, fear of missing out. People buy at peak prices only to watch the coin dump. It's often a pump and dump scheme. Hype is used to inflate prices before early investors cash out. It makes you ignore red flags. Projects with no real use case seem legit just because influencers promote them. Common hype narratives and why you should be cautious. This altcoin is the next 1000x gem. 99% of hyped altcoins crash within months. Most meme coins and low market cap tokens are purely speculative. Real investments grow over time. They don't explode overnight. This coin will replace Bitcoin, Ethereum. Every year, new projects claim to be better than Bitcoin or Ethereum killers. While innovation is real, network effects matter. Bitcoin and Ethereum have the strongest adoption and security. This influencer is buying it, so you should too. Many crypto influencers are paid to promote projects without disclosing it. Just because someone has a big following doesn't mean they're credible. If they're shilling a coin with no real utility, it's likely a pump and dump. Key takeaway: hype is designed to make you act impulsively. If you don't do proper research, you'll end up holding worthless tokens while insiders take profits. How to avoid falling for FUD and hype. Follow a fundamental approach. Instead of listening to the noise, analyze the fundamentals. Does the project have real-world adoption? Is the team credible? Does it solve an actual problem? Do your own research. Never invest in something just because someone else says it's good. Read white papers, check on-chain data, and follow developer updates. Ignore headlines and stick to a plan. Set entry and exit strategies so that market FUD or hype doesn't affect your judgment. Stick to data-driven decision-making, not emotions. Use risk management strategies. Don't go all in on hyped projects. Use stop losses and portfolio diversification to manage risk. Don't chase green candles. If a coin has already pumped 500%, it's too late to enter. Buying high due to FOMO usually ends in losses. Think long-term, not short-term. Short-term traders get trapped by market noise. Long-term investors benefit from adoption and technological progress. Why successful investors ignore hype and FUD. The best investors and traders in crypto understand market psychology. They know that FUD creates panic selling, which is when they buy cheap. Hype creates euphoria, which is when they take profits. Example 1. Bitcoin's 2018-2020 bear market. Many people panic sold at $3,000 after the 2018 crash. Those who ignored FUD and held through the bear market saw Bitcoin hit $69,000 in 2021. Example 2. Shiba Inu's 2021 pump and dump. Many retail investors FOMO'd in at all-time highs. The price crashed 90%, leaving those who chased the hype with massive losses. Key takeaway. The best opportunities come when others are fearful, and the worst mistakes happen when people chase hype. The winners stay calm and execute smartly. At the end of the day, staying calm during volatility isn't about ignoring reality. It's about controlling your reaction. The best investors don't panic, don't chase hype, and don't get emotional. They stick to a clear strategy, focus on the long term, and use volatility to their advantage. If you can master this, you'll not only survive the crypto market, you'll dominate it. If you found this episode valuable, smash that like button, drop a comment, and subscribe for more insights on crypto investing, market psychology, and smart trading strategies. See you in the next one. Follow us on X, YouTube, Medium, Instagram, and Threads at True Crypto Insights and Crypto Tribex for podcast.